Google just unveiled powerful new Gemini features, including language learning, and this could be the biggest threat Duolingo has ever faced. Now, if Google can teach languages directly inside Gemini, Duolingo's moat, the competitive advantage behind their growth, may be in serious danger. So in the video today, we're going to break down exactly what Google is doing, what it means for Duolingo's business, and most importantly, whether Duolingo stock is still a buy, or if Google investors are the ones set to benefit, and that should be the company to consider. So let's dive straight in, and firstly mention the comparables in terms of the performances. Google over the last year is up 25%, year to date they're up nearly 10%, and they're also trading very close to their all-time highs, where both Seeking Alpha and Wall Street give this a very decent rating of a buy, 4.23 and 4.43, both near the 4.5 that would flip them into a strong buy, and the valuation does sit on a forward P below 21, which in comparison to Duolingo, very strong in the last 12 months, up 50%. Year to date though, they're down. Over the last 6 months, they're down significantly, we're talking 18%, and you can see pretty much in the more recent period, this one has been on a downward trend. Now, it's not that near to their 52-week low at $200, but it is making its way there, and their all-time highs sitting at $545, quite some way away. Now, not as strong in terms of the buy ratings from both Seeking Alpha and Wall Street, but clearly they like it given the rating overall, and the valuation significantly higher than Google, above the 95 mark. Now, the CEO gave an interview not that long ago covering many topics. The one that we really just want to bring to your attention, especially for those maybe newer to the company, it was asked to him, Duolingo, essentially, what is their business, how do they make money? And firstly, he calls it an app where you can learn languages, but actually as of now, they've got a few additional features where you can also learn maths, music, and chess, and it's also a free app. Like many things these days, it does come with a lot of adverts, and that is ultimately where they make the money, where subscribers essentially pay a monthly fee, and those ads are removed. Now, in terms of the percentage, they currently have 90% of those users not paying a single penny, and in fact, they don't really do a lot of marketing. The majority of their new users does come in fact from word of mouth. As we can see, main marketing is in fact those free users, and even more importantly, as this is one of the issues they're facing now, why would someone use Duolingo instead of a chatbot, one that they're already talking to on a day-to-day basis, something like ChatGPT? And he puts it down to it could get pretty boring after a while. Now, that tells us straight away, not the strongest moat if you're really putting it down to being boring, because that is quite subjective on a user-by-user basis. But ultimately, the main thing here is the gamification, and that is what draws users to the app, something we will cover as well. Now, it's the beginning of the month where OpenAI launched GPT-5, and that was one of the reasons after their very strong earnings that saw the share price drop, because there was the expectation that their moat would now be penetrated hard, given users can do something fairly similar, competition is ramping up, but their earnings was very strong, hence why it shot up straight after releasing. Top line's up 41% year on year, and whilst we get a small deficiency to their gross margin, operating and bottom line were up 3 to 4 percentage points. On top of that, paid subscribers up 37% year on year, monthly average users, daily average users increasing rapidly, and worth flagging here, their business model does largely come from the subscription base, 211 million from the quarter's 252. Now, this is very recent news, and ultimately Google Translate is getting AI-powered language learning tools that create customized lessons based on your skill levels and goals, currently supporting English, Spanish, French, and Portuguese. Now, it's not at the same level we're seeing from Duolingo, but that can always ramp up very quickly, and at the moment they offer live translation for real-time conversations in over 70 languages. It is also only available in the US, India, and Mexico, and the features use Google's Gemini AI to help you practice speaking, listening, and understanding a new language, very similar to Duolingo, but currently without the gamification. Now, Duolingo, as we highlighted, released their earnings towards the beginning of the month. Very strong numbers, massive beat on the earnings per share, a beat likewise on their top line revenue. And they're also seeing the percentage of monthly active users becoming more and more in terms of daily engagement. It's increased from 2020 at 23% to now 37%. That is a good sign, as always. That will drive larger advertisement revenue. And they're converting a very high rate now of those free subscribers into paid. That is ultimately what will drive their business higher and higher. 3.3% in 2020, now sitting at 8.5%, and their subscription revenue that we highlighted earlier, which had increased in the 40% region just this quarter, has been growing from 2020 at a 54% CAGR and doesn't look to be stopping, at least in the shorter term. And in terms of the EPS, well, over the next 4 quarters, they're projecting at a bare minimum double-digit growth. They do have a 75% track record. They've missed in one of them, although the previous 2 have been beats. And yes, they have a high forward valuation, but if they do hit their 2026 target, the forward PE will come down to 67. Is it warranted? Well, the growth does sit at the highest obtainable A+, year on year 40%, expected this year at 34%, which obviously is going to be well above the sector, but they are growing, like we have seen for most growth companies, at a slower rate than their historical numbers. Earnings per share moving forwards though, very impressive numbers, projecting 52%, although you do need to have a thesis that their moat isn't going to be penetrated, well above as well the sector at around 11%. Likewise, they are also very profitable, gross margin 72%, well above the sector, pretty much in line with their own 5-year. Bottom line strong 13-14%, not only above the sector at 4%, but historically they were actually losing money, something we can see now has completely changed. Now, institutions do hold a large percentage ownership at 92%. They've been selling around 3.2 billion in the last year, buying roughly around a similar amount, and in the most recent quarter they've actually been selling a little bit more than buying. So overall, no real key trend that we can spot, at least in the last 12 months. However, most recent quarter they have been net sellers, something that we see the opposite from analysts. This month, lots of them have not only been very bullish, but their price targets are incredibly high. We can see here targets of up to $600. We have KeyBank in fact upgrading their rating. We have JP Morgan believing this is a $515 stock, as well as Needham reiterating the buy rating after their very strong earnings. And their numbers are very impressive. The question is, can they continue this very strong momentum? And Forbes have raised the question whether or not the company is a buy. Can they continue to sustain very strong growth? They've set a target of around 30%, and they put this down to 5 different strategies. The first one is broadening their addressable market. Now remember, they have launched maths as one of the things that you can do alongside chess and the languages. So if they can continue to increase the different products that are available, that will also help perhaps convert those free users into paid, or at least bring more onto the platform. The other key thing here is really getting more subscribers on free to paid, and they're bringing up perhaps AI to differentiate this, whether it is through new lessons, exercises, or any kind of way that they will really not move on to say Gemini or in fact GPT-5, and conversion is going to ultimately what makes them sustain the very high growth levels. We also have here new learners in untapped markets, whether that's in fact expanding to China or India as noted here, and finally keep users returning on a day-to-day basis. Now, a survey went out to app users asking them whether or not language learning applications have helped them learn a new language, and we can see here in green, yes, I've successfully learned a lot, around 33%. If we combine that with the blue, which agrees but also believes you need more than one application, we're talking around the 50% mark. So around half of users who actually use apps like Duolingo believe it really helps, and this is something that needs to change. Sentiment needs to be a lot more positive to really drive this company as number one, otherwise their moat will get penetrated and very quickly. And we have one user who has a very high streak, in fact talking about some of the issues that she believes going on with the application. She says the streak made her use the app daily but for minimal periods, sometimes under 1 minute, incentivized her to pay for a streak freeze to maintain it, and also made the app less effective, aiming to add to the streak rather than generally learn. Now, it would be good to hear from users if they believe any of this to be true, what their views are overall of Duolingo, and whether they're a free or paid user. Now, we've highlighted the forward valuation does look to be very high, but if we actually look on a price to earnings growth basis, it sits below 1, which, remember, that is where we would say a lot of opportunities could be had, and it's also lower than the sector at 1.81, so you're getting a 49% discount. Remember though, this is based on future expectations of growth, so if the moat gets penetrated and that does affect numbers, then this will ultimately change. In comparison, when we look at Google, it's trading at a forward PE below 21 when historically it's been at 22, so we would say this looks to be undervalued. With these new features as well, if they do have a strong effect, maybe take away some of the users of Duolingo who have been paying, then it's one additional thing they have in their armor. And when we look at the blue tunnel, which does signal the intrinsic price, it is sitting towards the lower end, so you could argue reasonable valuation / slight undervaluation, although noted during the last few months this one was trading in a severely undervalued level. Remember, make sure you're subscribed, notification bell is on. High quality companies in an undervalued level, we will make you aware. And unlike Duolingo, where it was hard to see any institutional trends, well, the opposite here, 40% ownership, but 58 billion worth of selling. That is a lot in the last year, but we notice here more than double that in terms of buys, 127 billion, and in fact they've been buying around 3 times as much in quarter 2. Now if you wanted the reverse of the trend, you'd have to go and by quite some distance to quarter 2 2023, really highlighting more often than not institutions are very, very bullish on Google. Obviously though, the growth has no comparison between the two where they get a B-. We're talking around the 13% level last year as well as this year, which is actually slightly lower than their own historical. Again, no comparison to Duolingo, with earnings per share projected to be a lot lower. We're talking 15% when the historical sits at 18, and likewise that reflects on their earnings expectations. 3 of the next 4 they're anticipating growth at a double-digit rate, whilst also outperforming in the last 4. Now their growth isn't that much in comparison to prior year, and therefore if they hit that, the forward P will drop, although slightly, to below 20. And before we jump into the valuation of both companies, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now we'll kick off the valuation with Duolingo first, which comes to $379 derived from the DCF. Now as you can see, we have their free cash flow. Most recent increase was 89%. We've gone a lot more conservative at 20, where we have a low, medium and high, 15, 20, 25. As always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Duolingo or any others. And also worth flagging, on a reverse DCF, there is 17.1% of free cash flow growth already baked into the numbers. So you need to see it higher than that starting off to believe it does look undervalued, and using 20% with a discount rate, we get the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to 379, indicating 20% upside. Now, full transparency, we'll show you at the 15%, 274, indicating downside of 13, and if you believe we're being way too low, well, at 25, 522, 66%. Now we're not done there, because we take the middle rate through to the final slide, and what this highlights, if you believe these assumptions to be reasonable, as of today there is a 17% margin of safety. Wall Street themselves see this at 480 on average, although many analysts believe it will be much higher in the $500 to $600 region, but on this, that is 52% upside into 2026. Now if you want to see this at a 20% MOS, well, at buy at 303, and at 25, 284. One thing we'll also do, for those that believe we're being too conservative, at the 25%, where intrinsically it comes to 522, you can see you're getting a 40% margin of safety. So on Duolingo, give us your thoughts. Do you believe the moat is about to be penetrated, or do you see them maintaining this growth rate for a very long time? We'll then also show you the same for Google, where intrinsically we get to 229, and we have used a growth rate of 12%. You can note baked in as of today is 10.5, so if you believe this is high or want to be conservative at 10, then we're talking downside of 3%, and at 14%, we're talking 263, 28. So using the middle rate, which we do believe to be reasonable, you are getting a 10% margin of safety. If you wanted this at 20, well, a buy at 183, and at 25, 172. Wall Street see this 220 into next year, upside of 8%, so it doesn't really compare to what we've noticed from Duolingo. Two completely different stocks. In your opinion, do you see them as a buy, hold, or avoid? Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.